All right, we have Chris coming in from Xiaobing's office. Again, everyone, I apologize for the delay. Severe technical difficulties on our end. But again, thank you for joining us. Thank you for being here for today's webinar. I'll give Chris and Xiaobing a minute to get situated. Chris and Xiaobing, whenever you're ready.
We're ready. Go right ahead, Holden.
All right. Next slide, please. Well, I'm seeing and for those of you in the chat, please let us know. I'm seeing the PowerPoint window not in presentation mode.
It doesn't look like on this computer we can get it to presentation mode, but
okay.
Let me go ahead and collapse it and we'll show it like this. How's that?
Yeah, that's perfect.
Okay, we're on the Who is Chmura slide. Can you see that, Holden?
Yes, I'm good there. All right, so welcome everyone to today's webinar, Applying Economic Impact Studies. Our speakers, as I'm sure you know by now, are Chris Chmura and Xiaobing Shuai. And if you're new here, we generally like to do a little slide about Chmura and what we do. So we provide labor market data and analysis so you can make informed decisions to help your community and business thrive. Chmura was founded in 1998 by Chris, and there are two offices, one in Richmond, the other in Cleveland. We are economists, data scientists, statisticians, and business professionals who truly care about helping your community and business grow. Two things that drive us are client satisfaction and success, and our first priority is excellence, both in customer service and in data quality. Besides excellence, three other ideals that we prioritize are thorough, accurate, and useful. So these are there are four things that really guide our organization. They drive us, and they're what we aspire to be. One way we truly try to exemplify those values is through our labor market resources. We believe that everyone deserves access to high quality economic analysis, which is why we offer a lot of free resources. One of those being the weekly economic update, where we send out the most up-to-date national data and analysis every single week. For those of you that are interested in that, I will put a link in the chat where you can sign up. And then before we get on with today's webinar, and I pass things off to Chris, I wanted to mention that we will be sending out the slides and the recording to all of the attendees tomorrow. If you have any questions, please don't hesitate to put them in the chat, and thank you for joining.
Thank you, Holden. So before we get into our presentation, just wanted to give you all who are JobsEQ users heads up that we're having our JobsEQ Summit 22 Users Conference after 2 years of going without one because of COVID. The dates October 9 through 13 at the Ritz-Carlton in Cleveland, Ohio. And for those of you who think that's going to be too expensive, we got a great rate, and it's even a little less than our previous conference. A great time to attend workshops, network with your friends, listen to some data experts. Just two highlights for you. Mark Schweitzer from the Federal Reserve Bank, he's a senior VP, will be speaking. He, in his research, looks at the macro impacts of labor market development, and he also looks at the factors that contribute to regional growth. So he'll be one of our main speakers, along with Derek Hilbert, who's currently the Director of Talent Acquisition at Hanes Brands. Previous to that, he was with Lowe's in strategic workforce planning, including initiatives around culture, diversity, and inclusion. And you can look at his LinkedIn for more information. on his background. And if you you should start to see things coming out online about the conference. If you want more information, you can write to Holden at this email address here. So our overview for today, I'll be looking at the national economic outlook. We're above trend growth through 2022. The federal government stimulus is winding down, but that's still having an impact on the economy. The Federal Reserve, even though it's increasing interest rates, is still very stimulative. We'll talk about that. And then in 2023, are we going to see a recession or what we economists call a soft landing? That is, the economy slows down, but picks back up and we don't go into recession. And the answer for that revolves around when inflation is going to slow, how far interest rates will have to go up in order to slow down inflation, and also will the supply chain disruptions ease. And I'll cover all this rather quickly so we can get to Xiaobing, who will talk about the importance and usefulness of economic impact studies. So in terms of the national economy, here you see on the right-hand side, the recession defined by the National Bureau of Economic Research was 2 quarters long, was very deep, but not as long as the previous recession called the Great Recession, because it was the deepest, the longest recession since the Great Depression. But again, coming to 2021, you see the sharp growth that we saw. And you also see our forecast. Notice that we have very slow growth once we see first quarter coming out. And the reason for that is basically because of the Omicron variant. When we had the Delta variant, we also saw economic activity slow down. But in terms of our forecast shown in red here, you can see that it's growing above trend. Trend is about 1.8%. And here we're looking at 2.5%, 3% growth. Anything again above 2% would be considered very strong. So as we look at the labor market, it remains very tight. The unemployment data just came out last week for March, and the unemployment rate continues to go down. On the right-hand side, thankfully, the participation rate is starting to inch up, but we're still far below what we saw back in February. Pre-pandemic was 63.3%, now it's 62.5%. So we still have about 700,000 people that, if we were back to the pre-pandemic levels, we'd have that many more people in the economy. But those people are sitting on the sidelines right now. When we think about the fact that this economy is opening up, we have people, businesses that have strong demand for their goods and services. At this very time, when they need more people, we're seeing a very high quit rate. So here you're looking at a survey from the BLS that started around 2000. Gray shaded areas are recessions. And when we go through a recession, people don't quit their job because they're afraid if they quit and take another job, maybe the job won't work, maybe the demand won't hold up for that business's products, and then they'll have a hard time finding another job. So quit rates go down. That happened in the COVID recession. And then when we came out of it, quit rates jumped to the highest level that we'd seen over the 22 years or so of having this survey. So in November, the quit rate was at 3%, 4.5 million people looking for jobs. Latest data in January is showing the quit rate at 4.35 million, and that's a rate of about 2.9%. So here we are, the economy's growing, and businesses are having an even harder time holding on to workers because they're looking to go to different work. So now we have the inflation complications. This economy is finally growing at a good pace, almost getting back to pre-COVID levels in terms of employment, and we have inflation taking off. So here I'm showing you two measures of inflation: consumer price index, which is what you hear about in the newspaper often, and it's up nearly 8% from a year ago. This is based on a basket of goods, so every couple of years they'll change the proportions of what consumers are buying based on what they've bought in the past. But the Fed prefers the Personal Consumption Expenditure Index, PCE, because that changes every month. So if one month we're spending more on rent than on gasoline, then the proportions will be changing. So the Fed believes that the PCE is a better measure of inflation, more accurate, and you can see it's just up a little bit over 6%. Still very high, and many people on this call probably never lived during a time when inflation was more than, say, 2%, because that's the target that the Fed tries to keep us to, because that gives us a more balanced and long-lasting business cycle. Now, when we look at compensation costs, here up 5% from a year ago with the latest data from the fourth quarter. And this is when the Fed starts to get concerned. They were thinking this was transitory. It was going to start to come, inflation was going to come down as the economy opened up, as supply chain got better. Now, some people are saying we're going to have supply chain problems through the end of this year, maybe to mid next year. But when we start to see inflation going up, and we expect that inflation will continue to go up, then when we get our pay increases, we expect it not only to account for the past increase in inflation, but perhaps for future increases. And so it starts to snowball, and the Fed clearly doesn't want that to happen. And so they start increasing interest rates. And so that's what we've seen them doing. Here I'm showing you just three rates. The federal funds rate, which is the only rate that the Fed can directly impact. It's the rate that banks use to loan each other on overnight funds. But when it goes up, other rates go up. So the prime rate goes up by the same amount. Then the 3-month bill will start to go up, 6 months, 2 year. And those things are tied to loans. So consumers are paying more for the loans. The 10-year bond goes up as well, but that's more tied to inflation expectations than to Fed action. But in any case, this impacts the price of mortgages. And so mortgage rates are starting to go up. So the whole idea here is Fed pushing up interest rates to slow down this economy a bit so that people aren't purchasing as much, so that inflation will start to come down and we'll get to that better level of about 2% when the economy operates more normally. And by the way, if you all have questions, please put it in the chat and we'll answer those at the end of this presentation. So question is, how far will interest rates go up? Xiaobing and I participate in the blue chip financial forecasts. We just put in our forecasts on April 1st, and there are about 50 economists that produce these forecasts that are published on a monthly basis. Some of the other groups, Morgan Stanley or Citibank, are among those that submit their forecasts for publication here. And to give you an idea of what these economists are looking for, in the fourth quarter of 2022, the economist with the highest forecast says they think the federal funds rate will be 2.6% by the end of the year. But a better way to look at it is the consensus. So what's the average of those 50 economists? They think the federal funds rate will be at 1.8%. Treasury, the highest forecast, 4.5 by year end. Consensus is closer to 3%. That means the 30-year mortgage, if you could believe it, some people think it's going to be as high as 6.5%. That would really slow down the housing market. Consensus is 4.7. But let's go forward just 2 more quarters into 2023. Federal funds rate at nearly 4%. Consensus just a little under 3%, with the Treasury note for the consensus getting up to 3% and mortgage rates up to 5%. So the moral of this chart is if you're going to buy a house, and now's the time to move on that. And then the Federal Reserve Bank presidents, as well as other voting board members, will make comments. And then we had some comments made this morning that are similar to this, that really caused the markets to move in a bad direction. That is, the stock market's down. And she was saying that we need to start reducing the balance sheet sooner, and that we need to move that target Fed funds rate up to what she estimates to be 2.5% by the end of this year and further next year. So the point is, this economy is doing well right now. We expect that because of the stimulus, it will continue to do well over the next year. But we're starting to hedge our bets on 2023. That is, will the Fed be able to bring this economy into a soft landing, or are they bringing it to a soft landing that has a cliff right at the edge of it? So with that, let me turn this over to Xiaobing, and we look forward to any questions you might have at the end.
Thanks, Chris, for a wonderful introduction of our national economy. So my part of the slide is a little bit more technical. It's basically looking at the economic impact analysis. I guess the objective is not for you guys to perform the analysis, yourself, but how to read the economic impact reports intelligently and ask critical questions. So today, so I'm going to introduce you mostly to the key concept related to the economic impact analysis. And the most importantly, I will show you some of the case studies showing that how economic impact analysis can help your field of the work. So first, from the bird's eye view, put the economic impact analysis into the overall different types of economic analysis. So I put the economic impact up here, and then you might heard about cost and benefit analysis, which is a little bit step further. Look at not only the economic impact of certain events, economic project, but also look at the cost of it, because economic impact, by definition, it's focused on the positive sides of the economic project or an event. Then, after the cost and the benefit analysis, then typically people would also go one step further, look at the return on investment analysis, and compare with the different other investment venues, such as interest rate. On the left-hand side, typically we also do market analysis, either on the labor side or on the industry side or on the different regional analysis. And that typically provide background for all other types of analysis. Sometimes we also do feasibility analysis. That's part of the market analysis. Not only look at what's the current market condition is, but also look at whether the condition can support a certain project that the people are interested in bringing into our region. So how people use economic impact analysis? Typically, we have worked with many organizations, and in my mind, any organizations can utilize the economic impact study. Some of the organizations use it to apply for government funding and financial support. I remember I've been working on impact studies to help organizations get the transportation's Tiger Fund. That name was under Obama administration. Under Trump administration, changed to Build Fund. I think right now there's a new name for it. But regardless, people want economic impact analysis to help them apply for the government funding. We also have organizations want the economic impact analysis to help justify the return on investment in the decision making. So some of the projects need taxpayer funding, and they want to see whether the benefits or impact can justify those type of community investment. We have done economic impact analysis, as I will show later on, help region target industries, which industry have the best, most impact to the region, benefit to the region, so that they can target. And impact analysis can also be used to fulfill regulatory requirements. Recently, we have done not with the renewable impact analysis with the renewable project, because I believe as part of the filing for the permission or permits, many of the government require economic impact analysis done. And also, before the Great Recession, when we have the real estate boom, we did the impact analysis for several real estate development, because one of the county, Richmond is close to right now, have the requirement that for any real estate development, you have to have economic impact analysis done. So finally, a lot of organizations use economic impact to educate the public and build the public support for certain projects. So economic impact foundation. First, in this case, we just have to define what is economic impact analysis and what is the key terminologies. You guys probably hear, such as the linkages, economic linkages, or different types of economic impact, different three types of economic impact, or the multipliers. So I'll explain all of those impacts. So basically, by definition, economic impact analysis is a study of changes caused by an economic impact event on the other parts of the economy. So in this simple definition, you may wonder, what is economic impact? What does the changes to other parts of the economy mean? So first, let's look at the economic event. So economic event can be basically anything that can affect the broader economy. We can call it economic event. Some of the projects we have worked on, including business relocation, expansions, tourism attractions and festivals, educational institutions, I forgot to write hospitals, healthcare institutions, real estate development, energy project, sporting events. All those can be classified as the economic event. Then by the definition, we studied changes to other parts of economy. What does other parts of economy mean? So basically, it means that how do we measure the economic impact? We study how an event affect the spending or the output impact or the GDP impact, because people typically using GDP. Some people like to using GDP to measure the overall size of the economy, but some other studies using output impact, which is bigger than the GDP, because the GDP it's only measure the value added portion of the output. But someone want to see overall sales or spending impact, then we look at output. Another part of the economy that will be impacted are the employment or jobs. And some other measurement of the economic impact, including labor income, so how a new project can affect the labor income, wages and benefits of the region. And finally, for the state, local, and federal government, they are interested in how the economic impact can affect the tax revenues. Here, I want to just point out that economic impact, although it's in my mind, it's wonderful and it's very useful, but some of the impacts they are not panacea for all. Some of the impacts cannot be directly estimated by the traditional economic impact model. Some of those things are population changes, how the project can impact the population of a region, or the property values, or the transportation impact, or some of the cost for the government. And finally, the current economic impact model cannot measure the impact on the competition. So it's not that we cannot do it, but the additional analysis will be needed, so that we have to jump out of the traditional economic impact model to do additional economic analysis to do that. So before I go further, I want to explain a little bit about the difference between the event region and the impact region. So event region is typically where the event takes place. For example, in the example we have an event happening in Richmond, city of Richmond, and that's the event region. The impact region can be varied, because one event happening in the city of Richmond, when we are in now, can impact the city, can also impact the bigger Richmond metro area, or can impact the whole state. So those are the impact region that can vary. So if you guys are in the market shopping for economic impact analysis, probably your consultant will ask you, what is the region, impact region you want to measure, and it's a county or metro area or state, and that's what it means. But event region can only be one place. Next, we are dig a little bit deeper into some of the what underlies economic impact analysis. What do economists like Chris and I are looking for when we analyze the economic impact of economic event? So first, I want to introduce you to the concept of the economic linkage. So typically, we as a business, or as an organization, or as a household, we do not live in the vacuum. We have different connections with the other parts of the society. So basically, every business and industries is linked with other businesses. Some of those linkages are local, and that's where economic impact are focused on. Some of the linkages are outside the impact region. We call it leakage. I'll explain it later on. So how do business and household are linked with each other? Typically, sometimes they through supply chain relationship. You probably heard many people talking about supply chain, especially during the COVID. So that's the relationship. That's a linkage. Business connect with each other. So business purchase goods and services from local businesses. That's a supply chain relationship. And the business sell their goods and services to other local businesses. So that's another supply chain relationship. Then every business also linked to the household through the labor and the consumer market. So here basically it's a visual, and not a very pretty visual, but try to that explain the economic linkage. So we have business here, we have household here. Business linked with other businesses through the supply chain relationship. Then business linked to the household through two relationships. One is the business hiring workers, laborers. The other is that the business is selling goods to the households. And then finally, there is the leakage here. That is the flow of the transaction that's go outside the region. So look at this diagram. You can consider it as a local economic system, and some of the economic activities were leaked outside. We call it the leakage. So, excuse me. So basically, to summarize those, and the business and the household are the two main players in the market analysis, and we use as input-output supply chain relationship that link the local business together. Then through the employment and the consumption relationship that link the business and the household together. And why I highlight these two types, because it will flow directly into the next section where we call the indirect induced impact, that it's directly related to these two differentiation. First, we look at the business-to-business relationship through the supply chain connections. Then we look at the business-to-household relationship through the labor market and the consumption connections. And finally, it's the government. They have a role in all these linkages by providing regulations, also by collecting taxes. That's where the fiscal impact comes into play. So I mentioned leakage before. So the concept of leakage, thinking about that some of the local business would purchase supply and services outside the region, so their money leaked out outside the region. Other examples of leakages including business hire workers from outside the region, so that they're benefiting other regions. And also local households spend money outside the region. And those are all classified as economic leakage. So as I mentioned before, those type of how business and business related and business household related flow directly into three types of economic impact. So first, we call it direct impact. It is the initial value of the economic activity. So in this case, if you are thinking about a construction project, that direct impact is the initial construction spending. And then the direct impact focus on the business-to-business transactions, and it excluding the household impact. So when I say that, it's basically the indirect impact measure how this direct impact can benefit other business in the region through the supply chain relationship. Then induced impact basically measure specifically the effect of labor income to the household. So through this direct impact on the business hire workers, and those workers are spending their labor income in the local communities, and that part capturing the business to business to household, then household to other business, and that summarized by the induced impact. I'm sure you guys all heard about the concept economic multipliers. Basically, multipliers are the standardized version of the indirect induced impact. So when we talk about indirect impact, it can be $1 million or billions of dollars. So to compare the effectiveness of the different project, people use the concept of multiplier. Basically, output multiplier measuring the ripple spending impact based on a $1 change in the direct impact. While the employment multiplier measure the ripple employment impact or jobs impact based on a one job changes in the direct impact. So that through multipliers, then we are able to compare different projects and how much of impact those projects will have on the economy, and will help people pick and choose what industry to target. So the employment and output multiplier are the two main multipliers, but other people also calculating labor income multiplier and GDP multiplier. So they follow the same concept, but it just they are calculated somewhat differently. So some of the practical knowledge as you start reading the economic impact, I find it very useful because it will help you to ask critical questions to evaluate the economic impact report when you are reading them. So some of the knowledges I find useful are understanding what type of factors affecting the economic linkage and the multipliers. First, the size of the local economy, because the larger economy typically would be able to retain a lot of economic linkages and reduce the leakage, so that a project would have a bigger economic impact. The diversity of the local economy would help the economic impact and the multipliers, because when a region has a more diversified industry base, which a new project are able to find a different service in the product it can from the local economy. That's why you are able to retain more economic benefits within the local economy. And finally, some of the industry concentrations, I'm not trying to throw out the terminology here. The location quotient, higher location quotient, typically is associated with somewhat bigger economic impact or multipliers, because they're higher concentration, meaning that they have a clustering in certain industries are able to help industries to get whatever they need with a larger cluster. Understanding the limitation of the economic impact analysis. So that's why I always tell our clients it is based on the average firms in the area at the particular time when the impact model is established, so that if you have a new business, or if your business have a very high wages or very low wages, and those standard multiplier need to be adjusted, because that would affect the economy differently. And whatever we built in the current model are based on the industry average. So it's very important to note whether your project is bigger or it's different from the industry average. Sometimes the limitations of the model is that the new company or new project can have very different input-output relationship from the existing firms. So that would might throw the economic impact analysis off a little bit because of those new relationships. That is extremely relevant when you try to introduce a new industry into an area, because they currently do not have an industry base to support this brand new industry. So the multiplier estimate will be low. Imagine if the new industry can establish in a region, they were able to source more suppliers in the future. They will have a larger impact, but just the current model will not show it. some of another limitation is that I've mentioned before, some of the things cannot be estimated by the traditional economic impact model, such as population changes, competition, change in asset value, and additional analysis needs to be done for those questions. So some practical knowledges. So currently in the market area, they have 4 or 5 impact models that is being used. So you guys probably familiar with some of those. For example, Implan, it's one of the popular models. REMI, it's another popular models. And the third one, it's created by Bureau of Economic Analysis. It's called RIMS model. Then Chmura, of course, we have our own in the JobsEQ platform. We have our own economic impact model to help you do economic impact analysis. And some our competitors like MC have it. Well, they were bought by the Burning Glass right now, so they have their own economic impact model to do the analysis. So how it works in JobsEQ, and when we developed it, so we typically start from that. I think that is also similar to many other economic impact models. We typically start with the national input-output metrics published by the BEA. Then we're using regional economic indications such as industry mix, diversity, concentration to construct a regional input-output metrics. Then we're using regional input-output metrics to estimate the economic multipliers. And finally, we take your input. If you are the JobsEQ customer, you can put in the input such as the dollar amount of investment or number of jobs. Then we take this and we spit out economic impact report. So just some of the comparison I did a while ago, compare Chmura's JobsEQ economic impact model with some of the other popular economic impact model. They are fairly consistent, but typically Chmura's model it's a little bit more conservative. And this block will be updated soon because we are working on updated version of our JobsEQ economic impact model. But we typically take a little bit more conservative approach. We use the latest wage data to compute the employment multipliers. We also do consistency checks among geographic hierarchies. Well, what I mean is that typically when your event happened, you cannot have impact in, let's say, in a county should not be bigger than the impact in the metro area the county is in. But in some of the market models, we typically find that sometimes they give out a larger multiplier for the region than the county. So, but JobsEQ have our consistent check on that. That's why we were a little bit more conservative. So last but not the least, I will show you some of the examples we do. I'll go over quickly because I still want to leave some time for questions. As I mentioned before, we have extensive experience in impact studies, and many industries, and we have many industries, including transportation, energy, tourism, education, healthcare, manufacturing, real estate development, you name it. But 3 examples I want to show you today, and one of the economic development project, the other is a major international tourism project, and the third is for the education institutions. For those who are in other industries, I'm not ignoring you, but these studies are in the public domain so that it's easy for us to share with everybody. First, economic development project. It's a major economic project. It's the Amazon's headquarters tool in Virginia and the Washington metro area. And so this is a huge project in 2018. Sorry, and we were hired to conduct the study to demonstrate that this project is beneficial for the state economy. Also can use to justify the incentives offered by the state. And finally, it's to build public support for the project. And we know that in Virginia is competitive in New York, and that's the last part. Incentive and public support is lacking, and actually eventually Amazon ended up withdrawing from the state of New York. But in Virginia one, it's successful. It's a huge project. So we first look at the capital expenditure with 1.6 billion planned investment. We look at the annual economic impact on the right-hand panel here in Virginia and in the Washington MSA. So each year, the total impact is about 800 jobs in Virginia during the construction phase. So actually, this is although this sounds big, 1.6 billion total investment, but compared with their ongoing impact after Amazon moved in, this is actually relatively small, because when all the construction is completed, Amazon second headquarters in Virginia will plan to have 25,000 permanent jobs. So those would have a huge economic impact in the state of Virginia with 14 billion annual economic impact and 58,000 jobs, because those 25,000 direct jobs, thinking about supply chain relationship, so thinking about all those high income paid to those workers, they are spent in the state, and the total jobs is over $58,000 per year. And finally, also these jobs can generate a lot of tax revenue for the Arlington County, where the Amazon second headquarters is located, and the state of Virginia. Annual impact is over $200 million in the state tax revenues. Another economic development example I want to show is that this is a study we did to help the region target potential industries. So we are asked the question: if we have 10,000 jobs, which industry should have the largest impact? So we basically look at the 3 different industries, then compare that with the overall. So there's a lot of numbers here. I'm not going to go over all of those, but basically the first slides have some of the direct impact you see, such as the new jobs and wages and direct payroll. Then the next slide showing that for different industries, what is the ripple economic impact in the region. So we have, especially they want to understand how the different retail and service industries in the region are impacted, including apparel, entertainment, financial, and all that. So with a table like that, and people can decide which new jobs in the region have the largest benefit. Second example I want to show, and I think this is one of the very exciting things happened in Richmond since I lived here for 20 years, is that Richmond 2015 is a tourism sporting event that it only happened the second time in the United States, and Richmond won the bid in 2011. I also want to highlight this study because we did 3 studies and with different purposes. First, it's the first study. It's before Richmond won the bid. We did the study help to Richmond win the bid, and the second study is after Richmond won the bid, and we compared the study focus on the local fiscal impact, so that they can use it to go to regional, county, and state government, and to fundraising for the event. And the final study is that we actually did the study during the event, look at the people, survey the people from different countries, and to measure what's the actual economic impact will be. So here I will basically just show you some of the key highlights from the final study. And first, there is organizing this championship. Have the total budget is $23 million, and when they spend on the contractors, the securities, and other marketing professionals in the region, they're generating good economic impact. And finally, actually, the largest impact is that this event draw 645,000 total spectators to the region, and the amount of money they spend in the Richmond region, it's much larger than the organizers spent to host the event. So the total impact actually mostly derived from these visitor spending. It's over $160 million, generated close to $170 million impact. This is remember, this is only a 10-day event happening in 2015, generated $170 million impact in the state. So, the organizers also use the event to highlight some other community benefits of this event, including huge media exposure to the region and boosting other state and regional tourism events, and have the infrastructure development. And Richmond right now has a lot of bike trails in the region. Finally, educational institutions. So we do different studies for community colleges and research universities and the different programs. So what I'm highlighting here is the program impact for Dallas County Community College. They want us to look at the impact of construction, finance, healthcare, information technology, logistics, and the manufacturing programs. And we first look at the incremental income. Students go through the program, then we put it into the economic impact model to estimate the economic impact for each program. And finally, we estimate the return on investment for the student, for the taxpayer, and for the society, so that you will see what type of program to invest that will bring the highest return on investment. So I think I'm done. I think we have questions, but Chris wanted to talk about the JobsEQ Fit Certification.
Sure. Actually, Holden, did you want to make a comment about that? And then I do see we have some questions that came on.
Yeah, sure. So for those of you who are new or who are JobsEQ users, we do offer a training course called the JobsEQ Fit Certification. So for $400, you can walk through kind of the various layers of JobsEQ through training modules that you complete at your own pace. So it's, along the way, there are knowledge checks and quizzes to really help make sure you understand the workflows of your specific subscription. So one of the great things about this is you can use your account in unison with the Fit course. So for example, setting up custom regions I know is really big, and that's something that you can kind of follow along with through the certification. And this is something that not only we offer for our users, but also for our employees that work here. It's something that we use to learn ourselves. So if you're interested in the Fit certification or you would like more information, you can email me, holden.andrews@chmura.com. That will be a hyperlink on the slides that go out, and you'll see my email on the slides and recording tomorrow. So if you'd like to get in touch with me about that, I can set that up with your client relationship manager. So now on to our questions. Chris, there were a few from your section, so I'm going to start there. From Alan Sexton, are employers providing mid-year salary increases to help employees due to inflation?
So we're doing some work with some companies that are, yes, looking at that, and more, maybe not so much giving mid-year increases as considering how much of an increase. So typically, like one client was telling us, they figure out what their increase is going to be based on last year's increase in inflation. And so last year it might have been around 3-4%, but now we're already up to 8%. So his comment was, I'm now considering taking into account that we're up to 8% and layering that over where we were last year. So yes, it's something that employers struggle with. Of course, you have to be able to raise your prices to be able to increase salaries. And some organizations that can't, say maybe in businesses like restaurants that aren't as easily able to pass that on, you see a shift toward using more productivity enhancing equipment. So for example, some manufacturers using more robots, or warehousing using more robots rather than hiring more people. But I would expect that this year, with inflation as high as it is, that most employers should be accepting something higher than they typically see or have seen over the past decade.
Thanks, Chris. From Brandy Hernandez, why do we have inflation when the unemployment rate is decreasing?
Okay, well, when the unemployment rate is decreasing, that would put pressure on wages. Not as many people that we can hire, so you would expect to see wages starting to go up and inflation starting to go up. But the bigger cause is what caused inflation to go up to begin with. Part of it was due to the pandemic, the shutdown, us not being able to get the goods that we need to make certain products, so those product prices were going up. And then another factor on top of that was the Fed's loose monetary policy. So their loose monetary policy created more money in the economy. More money chasing less goods is when you start to see inflation go up.
Xiaobing, or Chris, from Brandon Demyan, are tax multipliers agreed upon for economic impact studies, as in certain types of jobs, or anything published that's a general consensus? So how are tax multipliers kind of chosen or agreed upon?
You mean tax multiplier?
I wonder if they mean tax rates.
Yeah, I think generally there is no standard consensus regarding any multiplier, tax multiplier or other employment multiplier, because each project is different. Also, as I mentioned before, if you put the project into different regions, New York or small counties, they would also have a different multipliers. So I would say that there's not no consensus on that.
Yeah, and then typically, I mean, we would add the taxes in after that to see what the impact is on revenue.
Mm-hmm.
And typically, and this is the way you should do it to be more conservative, you only estimate the taxes or the revenue that the region gets off of the direct impact. We don't consider the indirect or the induced, only the direct impact.
Yeah, and Brandon just wrote in and said they meant to say, just multipliers in general. Yeah. So does that change the answer at all? Are there multipliers agreed upon for economic impact studies?
I said there were certain ranges we have seen, but there is no consensus for a particular project, because, as I mentioned before, different region, different industries, even the same project put in a different region would have different multipliers. But there are some patterns we have seen, like some of the advanced manufacturing typically have a larger multiplier than some of the other jobs, such as retail and service jobs. So we have seen that.
Yeah, and just to give you a real-world example, as Xiaobing said, it varies by region. So Dell Computer, maybe 20 years ago, quite a while ago, was looking at either opening up a plant in North Carolina or in Virginia. They decided to go with North Carolina, Research Triangle, I believe, and a newspaper FOIA'd the economic impacts, the economic development's research on why they decided to give certain incentives, because North Carolina gave a lot more incentives than Virginia did. They used in-plan, the same model, both of them, but came up with different results. And the reason is because the manufacturing of computers, more of that was done in North Carolina at the time than in Virginia. So in North Carolina, they had all these supplier relationships set up. So the multiplier showed, so the economic impact showed that the multiplier was much bigger in North Carolina than it was in Virginia. So so that has an impact as well. But funny thing that happened maybe about 5 years ago, that plant, after its incentive period ran out, said it was moving out of North Carolina overseas.
Thanks for that example, Chris. We got another question from Cindy. She said, the leakages would be different for different locations/regions. Is there a way to account for this in the final impact analysis?
Yes. So actually, the leakage, what we have done in the JobsEQ is that we typically put the country as maximum impact, but of course it's not. Then we look at what's the impact in the region. Then the differences between those will be the leakage out of the country, out of the county or in the region.
Mm-hmm. All right, I'm seeing what looks like 2 more questions. So we've got one. Please share what advantages and disadvantages Chmura's economic impact analysis has as compared with other similar offerings in the market.
Yeah, I think I mentioned a little bit here that the Chmura, we have a little bit more conservative approach because we don't want to promise the moon when the project's coming in. So that is, we kind of intentionally choose to be a little bit more conservative. But our methodology is very sound and rigorous, just like some other models. Also, if you subscribe to JobsEQ, you'll get the multiplier actually updated quarterly because our wages and industry base was updated every quarter. Some of the other models you see actually updated once a year.
Yeah, and like Xiaobing said, there's a blog out there on that right now if you're interested in looking at it, and he'll be updating that blog when we get the new multipliers.
Yeah, the link to the blog will be in the PowerPoint that Holden will be sending out.
Yeah, and I've also put it in the chat. It's the second most recent message if you're curious. One final question. Is this the same multiplier that we see in the bridge and road projects that pay $1 or $1.64 per dollar in the local community based on a University of Michigan study quite a few years ago?
You mean the same model or same multiplier? For the multiplier, I would say it would be different because they have a different project. And also, I don't think University of Michigan a few years ago used our models, right? I'm not aware of it. So I would imagine it might not be the same.
Well, okay. All right. Well, everyone, thank you so much for joining. We apologize for the technical difficulties at the beginning, but we hope that this was a great webinar and very informative on economic impact studies. Just as a final reminder, I will be sending out the slides and recording tomorrow, and that will have links to all of the pieces of Chmura content that we've referenced today. And again, thank you so much. Have a good rest of your day.